welcome back to another video. In this video, I'm just going to answer a few questions that I've been getting on the other videos that I've been doing. So the first question is, when you buy a call option, what happens on the last day of expiration if you simply let it expire? Now, as the buyer of the call option, you're basically bullish. You would make money when the price of the stock is going up. Now, the closer it gets to that strike price that you picked, the more value that contract is going to have. Now, if it goes past the strike price, then that contract is going to be in the money, which is even better, right? It's going to hold more value. Now, when you're trading options, call options, you want to take the profits when you have them. Because one day you can be up on a call option and then the next day, hey, the price of the stock just dropped, right? So the way I do it, I take profits when I see them. But in this case, I'm going to show you a losing trade on a call option. And today is basically the expiration date. Now me, I like to sell covered calls, sell options. I'm normally not the buyer of options. Like I don't buy puts or calls that often. I do it, just not as often as I sell premium. So here, let me show you a quick trade. I don't really put that much money when I buy call options unless I'm pretty sure it's gonna, spike up or something. But in this case, here I'm gonna show you one that expires today. Now this is a call option that I bought on July 2nd. I bought it with an expiration date of July 10th, which is today. The strike price was $14. I paid 37 cents, which is $37 for this option. Now today, American Airlines is pretty much, right around $11.86. It's really not gonna go past $14 unless something, out of nowhere just happens and freak of nature just goes right up to past $14, which is highly doubtful. So today's the last day. This option basically has no worth to it. It says there's a bid of $1 and an ask of $1. In this case, I would just simply let it expire. It's not even worth trying to get filled in for $1. Now, some options on the last day of expiration will still have some value to them, especially if they're in the money. Now, so you can sell those options for some money on the last day. In this case, it's far away from the strike price. It's basically going to expire worthless. So by simply letting it expire, that's it. You just basically lost all the money that you paid for the option. The most you can lose is the money that you paid for the option as the buyer. So basically I lost $37 here. Now again, some contracts, they still hold value on the last day depending on where the price of the stock is. In this case, this is what happens when it expires worthless. By Friday, today, at the end of the day, this position is gonna just disappear. I lost $37 and then that's the end of it. Now let's say on Robinhood, if you let the option expire and it's in the money, meaning it's past the strike price by expiration, and assuming you have the funds in your account to buy 100 shares of the stock, if you let it expire and not do anything about it, then by Monday you're basically gonna own 100 shares of the stock. It's gonna be exercised automatically unless you close out the position. Basically, meaning you sell the contract back to the market. Now on the last day there might not be that much value, as much as you would have had a few days ago, but the other thing you can do again is just sell the contract back, and then that ends the contract. Basically you're not going to get exercised. Basically you're not going to exercise because you're the buyer, sorry. But that's what happens on Robinhood. If you let it expire and the option is in the money and you have the funds in your account to buy 100 shares per contract, then on Monday you would just wake up and see 100 shares of the stock that you just bought at that strike price. But in this case, I just wanted to show you, basically this is an option expiring worthless. Okay, now this is me being the buyer. As the seller of the option, when I sell the covered call, first of all, I sell it at the top as the price of the stock is moving up. So that's when you're going to get the most premium, because you know, if you were the buyer of the call option, as the price of the stock moves up, the more value that contract is going to have. So that's where I would sell the covered call. Let's say, for example, I would sell it right here. If I bought stock right here, I wouldn't sell the covered call here if I think it's going to spike up, or if it's going to move up, just a few cents, a few dollars. I want to get the most premium. So in this case, if you bought 100 shares here, you would want to sell it somewhere around here. Let's say if you want to do close to the money, or maybe a dollar or $2 out of the money. Meaning, pick a strike price. Right now it's trending at $11 and like 80 something cents. You can either sell it close to the money, which would be a $12 strike price. You get the most premium. I'll show you right now. So depending on which expiration date, of course, let's do July 31st, right? So if you pick July 31st, $12 strike price to sell 100 shares, even though you just bought them at like $11 or so, you would get, and this is basically real-time numbers, as the seller of the call option, you would get like around $130, because you're getting the most premium right now at the top. Now, if you sold the covered call here, go look at my other video where I show you how to get more money even after selling a covered call. So you sold the covered call here, you collected $130. Now you got the most premium so far. Now American Airlines can continue to go up, of course, but you don't know that. So if I wanted to sell the covered call, I would sell it at the top, right before I think it can have a reversal. So I collected $130 here. So what happens, if American Airlines starts dropping again? Well, I already collected the full premium. You do not want to sell a covered call as it's trending down. You're going to get less premium. You want to try to get it at the top if you can identify the, before the reversal. So you sold it here, and as it drops, that same contract is going to lose value, start losing value. So if American Airlines starts trending back to, let's say, $11 or $10 and something cents, you already made $130 right there. You collected $130. Now what you can do is up to you. You can buy the contract back if it drops even lower, and then keep the difference and wait for another bounce, and then resell that same contract, or roll it over for the next week or the next month, depending on what you want to do. Now again, I always wait for these kind of moves, the spikes, to sell a covered call so I can get the most premium. Now the opposite happens when I'm selling a put option. You do not want to sell a put option, and again, this is just my opinion. You do not want to sell a put option right at the top, because then you're getting, less premium. So if you pick the strike price, well, it really depends on the strike price, of course. But let's say if you pick a strike price of $10, or I'm sorry, $11 when you're selling a put option. I'm going to show you what it's worth right now. So these are the puts over here. So if you were to sell a put option right now for a strike price of $11, you would get something like $100 right now. However, if the price of the stock starts trending down right here, that put option is going to be worth more. So you're basically going to be losing out on extra gains that you could have collected on that premium. So the way I do it when I'm selling the put option is basically the opposite of what I'm doing when selling a covered call option. I like to sell them at the bottoms, and I'll show you a little trick right here. This is a 5-day, 5-minute chart. So I would sell the put option right around here. I would sell it maybe for like $10.50, because the price of the stock is close to $10.50, close to the money. I would sell a put option right here, collect the most premium right here, and then as the price of the stock is going to trend up again, right before the reversal, now you collected the full premium right here, and then American Airlines starts trending right back up to almost $12. And so that premium that you collected, that contract that you just basically sold on the put, it's going to be worth less. So now, using the same money you collected when you sold that put option, you can buy the option back right here since it's a lot cheaper now, and you keep the difference. And again, you can roll it over or wait for it to drop down again, sell another put option. So you kind of see when the price of the stock is going down, the put options start getting value. So when you buy a put option as the buyer, you're going to make money when the price of a stock goes down. As the seller, the put option, since it's getting some value on the contract, you want to get the most premium out of it. So the way I do it, I sell the put options when the price of the stock is going down, right before I think there's going to be a reversal. And I do it for the simple fact of getting the most premium. And if the reversal happens, just like it happened right here, then I would buy the option back right here. And then, make that difference right there. And then just wait for another drop. Now again, I only sell put options on stocks that I'm willing to hold. So you might have a different strategy. Maybe you're doing it just simply for the premium. I do it simply for the premium and because I'm okay with holding the stock if I get assigned. Now all this is just like the wheel. You're selling puts, you're selling covered calls. It's a great strategy. If you guys are not familiar with covered calls and selling puts, go check out my other videos. I do this a lot. And for me, it's been working out great. Again, I only sell puts on stocks that I'm willing to hold. If I get assigned, then I turn around and sell the covered call on it. It's all rinse and repeat. So you know what? When you're actually down, I'm going to show you right now. I'm actually down almost $2,000 on American Airlines. I bought them with an average price of $15.48. Now, I do not sell puts 100% of the time, but I do it, however, a lot of times. So in this case, I ended up buying at market and try to sell some covered calls. I'm actually down, but because of the covered call strategy, I'm down a lot less. I've collected around a little over $700 total so far on selling the covered call, buying the option back, selling the covered call, buying the option back. Now, if you want to keep it simple, you don't want to have to deal with hey, when do I buy the option back, blah, 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 even though I just explained it. But if you want to just keep it simple and just let the option expire worthless, or if your shares might get taken away, then just let the option expire. Now, again, I've explained in other videos what happens when you let the option expire and it goes above your strike price. Now, your shares would be taken away at that strike price. But at the end, it's all about making some money, right? Growing your account little by little. But I wanted to make this video for you guys, explaining to you guys when an option expires, a call option expires worthless, when I buy the option back, and when I just decide to sell it again. So if you guys have any questions, if you guys actually want me to do these kind of videos on Robinhood to explain it a little bit more in detail, because a lot of people are trading on Robinhood as well, I would be more than happy to. So just like the video, leave a comment down below what you want to see on which platform and stuff like that, and then I'll be more than happy to do it for you guys. So for now, this is it, guys, and until then, I'll see you guys on the next